Thank you. Hello and welcome to another episode of In Conversation with. This is a part of the CASI New York Knowledge Series. In the recent years, we have shifted from why to how. A few years back, I remember there were intense debates on the core reasons of existence of a company. Was it sole profits? And that there was a lot of stakeholders saying, yes, the profits are the sole reason of existence of a company. And I remember having participated in those debates myself. But today, that is not the question. Today, the question is, how do I make a meaningful impact? How do I create a unique impact in the communities that I serve? In fact, there are so many questions today. Confronting the purpose gap, imbibing CSR strategy in the business strategy, imbibing CSR strategy in the brand strategy. And finally, there is a question of how do all the actors fit in together? So right from the communities to NGOs to last mile delivery to corporates to governments and all the stakeholders, which role do they play? How do they connect so that finally the goals should be achieved of creating meaningful delivery, creating an impact, and at the same time running the successful company with delivery to all the stakeholders. So the purpose of the CASI knowledge series, the series that we are running, is to get executable advice. And that is the reason we reach out to experts in this field of sustainability. My name is Paresh Sept and I represent CASI Global New York as a member of the board of directors. CASI is one of the largest companies or platforms for CSR and sustainability across the world. We have a presence in 52 countries. We have a large education format. We are also into volunteering. In India alone, we have 3 million volunteers, making it the world's largest volunteering platform. And we have created a few IPs, intellectual properties, and world records within the volunteering sphere by doing behavioral change events. So with that, I welcome all the panelists, Robert Rubinstein, Richard Swart, and Raakhee Kulkarni. Thank you very much for joining us, all the three of you, on today evening in India. I'm sure it's a good morning for Richard, being in New York. So let's start with Richard.
Good morning and thank you. Good evening and thank you all for attending today. So my name is Richard Swart, and I am a civic advisor to a number of companies and impact initiatives. I used to be a professor. I've had academic positions at UC Berkeley and UC Irvine, mostly looking at the intersection of technology changes and social impact projects. And what I'd like to do today is talk about one of the companies that I'm involved with, which is a very interesting model. So I'm not here to pitch the company. I'm here to sort of present the way that they look at data and the way that they're using novel approaches, collecting and using data to evaluate impact investing. And this company is called CrowdSmart, and I'm going to go ahead and start my slides now. Give me a moment, please. Get the slide started here. Okay, having technical challenges. Just one second, please. Okay. CrowdSmart uses what's called human collective intelligence modeling to make predictions about the likelihood of both the success of an investment as well as impact that an investment might have. The founder of the company, Dr. Thomas Kaler, was the CEO of the first artificial intelligence company to go public. He's been in Silicon Valley since the very early days. A gentleman named Eric Schmidt used to call him for advice. A young man named Stephen Jobs asked him to help him. The chairman of the company, Paresh, was the product manager and launched the Java platform. So this is a Silicon the band back together. The particular group of founders has had, I think, 9 at this point. So they really created this company as a mission-oriented company to see if it's possible to improve upon the way capital is being allocated both for efficiency reasons and also for social impact reasons. So the field of human collective intelligence or human-powered AI is not very well understood, so if you don't mind, I'll take a second to discuss it. The key idea is that rather than debating whether human beings or neural networks or NLP systems are better, you try to figure out how to get artificial intelligence systems to work in conjunction with human reasoning, human experience, and human thought. And what the company has done is figured out how to collect human input from a panel of experts, and then to aggregate that input into a learning model, and then use Bayesian models and other techniques to build an actual prediction around the likelihood of an investment returning returns and also scaling. They tested it in Silicon Valley against early stage, seed stage startups, which is probably the most difficult place in the world to get financed, and the competition is fierce. And the model has actually proven itself to be over 80% predictive in identifying which projects are likely to scale. Interestingly, we have pivoted as a company in the last couple of years and noticed a couple of things. We did not intend to address social impact directly when the model was first built, but as we've analyzed our own data, we realized that we essentially accidentally engineered out bias from decision making. So there's essentially no racial bias and no gender bias decision process. And over 40% of the investments that have come through have gone to women, and a substantial number of investments have gone to women of color. And the obvious assumption is that we hide the identity of the founder from the expert, and in fact, that's not true. They see videos, they see pictures, they're very aware of the team. So what we found is that our human collective intelligence modeling system forces experts to evaluate fundamentals rather than using, if you will, simplistic heuristics or intellectual shortcuts that oftentimes basically bake in bias in decision making. So what we've also found is that although originally the target for this was private equity, venture capital, we've been approached by a number of organizations, everything from national governments to state governments to local economic development initiatives to groups focusing on sustainability, and to understand if there's a way of extending the model into impact investing per se. I'll go on to the next slides. As we all know, there's a massive inflow of capital, probably the largest inflow that we've ever seen, in that of funds flowing into sustainability funds. When you have Jamie Dimon and you have major Wall Street leaders talking about the need for sustainable investing, there's a massive push towards it, but unfortunately the vast majority of experts don't work inside Wall Street firms. So there's this massive knowledge gap between the knowledge of professional investors and the implicit knowledge of sustainability experts. And one thing that our platform does is marry those two. You can bring in an outside panel of sustainability experts or subject matter experts in a particular area, whether it's one project I was involved was a Better Cotton initiative using blockchain to figure out how to incentivize farmers in Africa to continue developing sustainable cotton crops. So everything from bringing in people to understand farming to bringing in people to understand nanotechnology, the platform marries the intellectual insights of professional investors with subject domain experts in a way that results in several times better predictions than just relying upon data alone without including human insights. So I'm not going to go through in too much detail, but what we found, especially in early stage investing or impact investing, there's a massive amount of knowledge about impact, about the community, about the resources, about previous experiments. And sometimes you need to have those insights. And oftentimes we think of it as a four-legged stool. You have professional investors, you have technical experts, you have people that would be users of or consumers or beneficiaries of the project. And then you might have academics or some person that can look at the data, look at the model externally. And if you can aggregate the inputs from all four of those groups in a way that basically drives them to evaluate fundamentals as opposed to arguing or as opposed to discussing. So this model is done asynchronously and online. And what we found is that oftentimes insights are surfaced from non-experts that you would think. So for example, a nurse might find a fundamental flaw in hearing aid technology, or a farmer may talk about the fact that even though it sounds good, their approach would never actually be used in practice. So this presents a model where even non-experts are able to present their ideas, and the platform is anonymous. So the other people on the platform don't know who's providing feedback. And in the background, we have a predictive model based on hundreds and hundreds and hundreds of evaluations of successful projects. The basis is, what does success look like? What would a successful project entail? So we're doing a match against previously known models using a Bayesian system. There's a logistic regression classifier playing. I won't get into the NLP and all the artificial intelligence in this discussion, but we do have AI running in the background, and it keeps surfacing insights. So put it more explicitly, there's an expert panel. We acquire that knowledge, all the insights then are built into a predictive model. That predictive model has been measured over for years. So we're able to actually have performance on impact goals, probability of success, what decision factors were critical to the team, both positive and negative. And we're also able to actually rank the expertise and input of the people providing data. So we have an expert management system that basically measures impact of ideas. So what we found oftentimes is female experts are oftentimes listened to in decision making. Experts that are not Caucasian in the United States are oftentimes not listened to. This platform allows the best ideas from the best minds to surface in a way that they're listened to and acknowledged and have influence on others. And there's companies that are now figuring out how to use this technology to identify the rising stars based on their intellectual insights, as opposed to the office politics and social factors that oftentimes drive decision making. And then we build in an incentive system and reward systems depending on the project. Sometimes it's just meet the founders, sometimes it's get a thank you card, sometimes it's cash, but the incentivization is a whole different discussion. But we found ways of increasing the participation of those people whose ideas have the most influence and drive towards the best decisions. So again, we found that over 40% of our companies were female-led. Typical Silicon Valley was 1%, and we have over 80% accuracy. So we're now pivoting towards substantial engagement around resiliency, sustainability. There's a new company called the Long-Term Stock Exchange being built in the United States, founded by Eric Ries, the founder of Lean Startup. And he is now using our technology to help build his data model around identifying those companies that have this likelihood of being both positive contributors to society, so positive sustainability indices, as well as having a business model that can weather crises. Unfortunately, a lot of sustainable business practices are not built upon resiliency, and his model basically marries the two, and our model is underneath that, empowering a lot of that decision making. So what we find is that as a group of experts get together, and this is as little as 8 or 10 experts, the mathematics have changed substantially, where you're able to generate highly predictive results from a very small number of experts interacting. 10 human beings interacting together can generate upwards of 5 or 10,000 data points to inform the AI system. So what we find, well, what our system generates is a ranked thematic analysis of the most critical factors and the critical ideas. They're ranked by the relevancy, and it both points out the strengths of the idea and the opportunity for improvement in the ideas. And then any reader can go in and drill down further and actually see the interaction and the ideas and the discussion between anonymized experts. And the platform has people ranking from very top tier academic experts, world-class experts, and major names in Silicon Valley, down to young scientists and engineers in their 20s. And what we find is that uniquely in this anonymized asynchronous system, that the younger and less socially empowered members of the team are oftentimes able to contribute the best ideas. And venture capital decision making is really a social influence function of the power of the founder or the partner. And this model takes away a lot of that. So it actually then focuses on the most critical factors and themes. So I won't bother going through all of the examples here. This is one we were doing. We did a lot of work around COVID in the United States and medical response, given the disaster we were having in New York. We did some work with Mount Sinai Hospital. The system provides visual representations. It shows the relevancy of your ideas. It allows you to look at, as a project sponsor, the relative experience of the person offering the contribution. Are they a scientist, or are they a subject matter expert, or are they a sustainability expert? But again, you don't know who that person is. Identity is anonymized from you. You just know their expertise and their relevancy. Over time, you're able to see which ideas and which ranks and which scores influence which particular aspects. In this particular case, it was looking at regulatory models, business models, vision, financial models, non-impact. We are retraining the system to focus on impact per se. And I'm going to go fairly quickly to my conclusion here, but the model is fairly groundbreaking. It does allow for basically accurate decision making in low data environments, so there's not a lot of information available. And so where there's not a ton of information available, such as early stage investing, you generate your own data, and you generate that data in a way that provides you comprehensive number of inputs and quality that's from a diverse set of experts. And we have Dr. Scott Page from the University of Michigan as one of our advisors, and he's mathematically shown, he's probably the world's foremost expert in diversity and decision making, that the most geographical diversity, educational diversity of the teams leads to better decision making. And a human collective intelligence system is the only way of baking diversity into decision making in a way that yields predictive results. So with that, I will stop and turn it over to everybody else, or be happy to answer questions at any time. And thank you for your attention.
Thank you very much, Richard, for the presentation. A quick query. Does CrowdSmart offer this as a SaaS model, software as a service, or how does it work?
Yeah, it is. And again, I'm not here to pitch a company. I just want to talk about differences to data. But yeah, it's a diligence as a service platform that plugs into other companies' technology.
So it is targeted toward impact funds?
It originally was targeted towards venture capital and traditional early stage investments, but over the last year and a half, there's been more and more demand from organizations looking at sustainability and resiliency in their roles. So we essentially are retraining the model to do both.
Okay, I have another question for you. Your work at the Silicon Valley Blockchain Association, you're saying it's an ecosystem towards creating a social impact. Could you explain it a little more, please?
Oh, yeah, I'd be happy to. So I'm one of the founders of an organization called the Silicon Valley Blockchain Society, and it's essentially a network of institutional investors. We have 600 roughly members. I don't remember the exact number, but between 500 and 600 members. At the height of the network, we had 1.5 trillion with a T AUM represented by the member room. So large hedge funds, pension funds, very large family offices. And it essentially was an organization that gathered senior level decision makers from institutional investors, as well as some large family offices that had an interest in promoting blockchain. And part of the charter of the organization is that 1 out of 3 projects have to have an impact focus. One of the founders is the head of the healthcare division of blockchain at the United Nations. I'm part of the United Nations Blockchain Commission. Many of us have intersections between academia and the United Nations, and we're looking at blockchain. We're very involved in the World Economic Forum, and we run several of the events at Davos related to blockchain and impact.
No, that is very interesting to us. We will take it offline. I will reach out to you for a further discussion on this.
Be happy to.
Yeah. So next we have Robert. Robert, a quick query to you before we go on to your presentation.
Okay.
Yeah. When did you shift your focus to CSR and sustainability? You are one of the world's leader. You know everybody everywhere in CSR and sustainability because of the events and the network that you have. You are probably the most well-networked person in the world in the field of CSR and sustainability. So when did you really decide to shift to CSR, sustainability, impact, ESG? Given that you have a background from Brooklyn in arts, history, and politics. So when did you really shift?
Well, I didn't really shift. It was always there. I think that's how I was just raised. And when I left the US in 74 to go traveling and did a variety of things. So I think probably in the 80s, I started the first bicycle magazine in the Netherlands and then did two other magazines. And the last magazine was the first European management magazine on sustainability. So probably I would say in the early 90s, late 80s. It wasn't really a shift. It was more kind of realizing that that was more important to me than dying rich. Money was not the motivation. And I've always focused more on sustainability than CSR, because the way it was done, particularly in Europe and in North America, it was a salad dressing on rotten salad. So it was, let's go fix up the neighborhood youth center, when the company was a bank that did most of the loans in fossil fuels and CO2 emissions. So it's about what you do, not what you report. And unfortunately, at that time, CSR was just it was a corporate communication story, but very few were actually integrating it in their core business activity. And if it's not in your core business activity, it's an add-on. It's not your, it's not your focus. So I would say late 80s, early 90s is, but I actually did work on oil rigs for 2 years. So maybe I did shift away from fossil fuels to this in the late 80s.
Mm-hmm. Sure. When we started CSR and sustainability, we were very well accepted in US, Europe, but it was difficult to make an entry in my own country, India, because back then I think we were too early. We were too early for teaching CSR, so people did not really want to learn CSR and sustainability. So
No,
in order to make the first
perhaps.
dent, it took us a couple of years.
Well, I mean, people were probably focused on survival. It's hard to get them interested in other things when people are looking at survival. When they have enough, when their belly is full and they have enough, they start looking at other things. It's unfortunate that too much of CSR was pushed as a kind of add-on, not as a way of giving, not as a case study that this will actually give you an advantage over others. You'll be able to attract the best and the brightest. You'll reduce governance risk. You'll reduce fines, et cetera, et cetera, et cetera. So it wasn't promoted enough as a core business focus, which is why a lot just saw it as a kind of communications exercise. And it was always, you always know how serious the company was. Who did the CSR manager report to in the company? Then you knew how serious they took it.
That actually answers my one of my questions, because I'm a great promoter of, I always reach out to boards saying CSR should report into the board directly. And the head of CSR should be a board or a part of the board. And, it becomes difficult to convince companies that you need this. It has to report into the board, and you are 100% on the target. Who does it report to? It says a lot about the company's intentions. It says a lot.
It's usually when they start, it's a woman, usually in Europe, you see that a lot, Europe and maybe North America. It's a woman who's always understaffed, underfunded, with a lousy office, who gets very little support. And the minute that she gets traction, a guy pushes her out of the way, takes over, and is in the photo op to cut the ribbon. That's usually how it goes. And then it moves up the food chain.
No, you are right. You are right. But in India, it is the opposite. India, we have a lot of CSR heads who are women, and believe me, they are very powerful people. So most of our CSR heads in India are very powerful. Most of them are women, and they are doing a great job. Yeah. So we'll move on to your presentation, and I will have a few questions again.
Sure, no problem. Okay, let's see here. Okay. Oh, wait, I think I have to go back. Go to here, share screen, right. Okay. And, here it is. Sorry. Okay. So I will try to cover in the next few minutes 25 years of ESG and impact. Is it a breakdown or a breakthrough? So for those of you who don't know who TBLI is, my wife likes to say we make dreams come true, but we're not in cosmetics. Our work is mainly changing the financial system so it works for all by educating asset owners and managers about sustainable investment. And we do that through education and advisory in various ways. So what I'll cover today is the definitions, what has happened in the 25 years, what are the forces, what are the cons and the opportunities. So when we started, 25 years ago with TBLI, trying to convince the financial sector is pretty much, you have to first understand, where do they see the earth as only a risk or only as an opportunity? Because that will determine what strategy you need to actually get buy-in. Risk and opportunity is really the issue. It's not about the moral imperative because they're not they're not compensated for the moral imperative. They're compensated for returns. Here are some definitions of what is ESG or extra financial investment. The definition that we use is the last one. So basically, while you are making a profit, are you worsening, maintaining, or improving the social environmental balance? I would say 98%, most of the companies in the world worsen the social environmental balance. Very small number actually maintain it, and an even smaller number improve it. But if you do that, you are probably incredibly profitable because you don't have such a high turnover, you don't have to pay any fines, you don't waste a lot of energy, you don't use a lot of raw materials, etc., which ultimately leads in a better bottom line. So here's some brief distinction between ESG and impact. ESG tries to be highly liquid, impact is less. ESG tries to be value add over the long term, impact tries to do in the short term. ESG is often about avoidance, doing less bad, where impact tries to be incremental and restorative if possible. ESG is somewhat measurable, impact tries to be clearly measurable, and most important, ESG is correlated to the stock market, and impact is not, which is one of the drivers for a lot of investors. So this is the really big story. Why is there so much interest in, all of a sudden, in sustainable investment? There are a lot of reasons, but here's one of the biggest. China's growth of 8% a year, if it's true, it means they reach US consumption levels in 2031. Maybe it's a bit later now because of COVID, but that will translate into massive consumption of commodities from oil, grain, meat, coal, steel, paper, cars, etc. Then you add India and the other 3 billion in emerging markets, and you can see that this linear line constantly going up is not possible because of an inefficient use of resources. There's not enough at this level of inefficiency to fuel that growth. So the line will go down. Financial investors don't like it when the line goes down. So the way you keep the growth line up and create jobs is either conflict for resources, war. They don't like that too long, but the real investment opportunity is massive resource efficiency, factor 10, factor 100, basically doing much more with much less. And this is really the main driver. This massive growth, particularly in emerging markets, have put pressures on Earth's carrying capacity. So you don't have to be a Nobel Prize winner to figure this one out. If we look at where we're coming from, all of a sudden, people realize that poor people with bad credit couldn't afford to buy a house, which led to the housing crisis. And then they all say, who knew? The challenges that we face is basically ignorance, particularly in the financial sector. How we get buy-in is basically a three-pronged approach. One of the biggest challenges is that those with a lot of assets, the more zeros they have, the more isolated they are. You know, Jeff Bezos doesn't have a sign on the side of his house, "Hi, I have billions, come visit me." So this isolation of Xanadu, of Citizen Kane, is very prominent. That is really one of the challenges, access. We have found pain is a very effective way in getting buy-in of companies. If they feel excruciating pain in the direction they're going, they will start to pay attention. But you have to really focus on the self-interest, as Friedman said. And most important, always look at the money flows. It's almost like a car accident. You know, when a car accident occurs, a few people gather around, then you've got a bigger crowd and a bigger crowd. That's the financial sector. They all look at the money flows, even if they're not really particularly interested in the subject, but they do watch where the money's going. So these are the motivation if you want to get buy-in of the financial sector, which has worked well for us. Show them self-interest, opportunity, and money flows, and do that over and over and over again, and you will get behavioral change. But we still have a lot of impact myths. Most of the financial sector think impact is a charity, it's no track record. That you hear all the time. But they never question the investment myths, which just says all investment managers always hit their benchmark. That's a massive whopper. That's a Donald Trump whopper. Private equity funds earn always 30%. Another mega lie. And hedge funds always earn 30%. Untrue. Most were giving money back. So we have to address all myths, not only the myths about impact investing, but the myths about the larger sums of money in the traditional finance space. I'm sorry, I went the wrong way. So, and then I often hear from the financials that ESG data is not good enough, over and over and over and over again. It's just not good enough. But the financial data is far worse, far worse. If we look at the list of all of the scandals we had, China Hustle, if you haven't seen the movie, watch it. It's the Big Short in real time, WorldCom, Enron, Parmalat, Lehman, the financial crisis, Madoff, Refco, RBS. It's in the trillions of dollars, and everybody seems to be comfortable with the idea of writing off trillions of dollars with fraud, and now Nikola, a truck company. And there's never a single incident where ESG data caused the bankruptcy of a company. In fact, it was the ESG analyst that predicted that BP would have problems because they spent 8% less on health and safety. And then I hear all the time, sustainable investing is risky, very risky. Do you know what this figure represents? This is actually, it's gone up a lot. It's the amount of money that the financial sector has spent in legal fees and fines since the financial crisis. The last one, not this one. These are basically the main drivers that are constantly pushing the interest in people in ESG and impact. Emerging market resource and efficiency, wealth holders trying to integrate philanthropy and investment, the financial crisis, staff and clients looking for purpose, not that much. Stakeholder pressure, students employee demand on employers and endowments. Wealth managers trying to engage with clients around impact, which is a much more effective way than saying, oh, I'm sorry, your portfolio is down 3% because interest rates are down, which is a dead conversation. But you can engage on impact because you have an emotional connection with that person, even though it represents a very small percent of the portfolio. And mainly people are seeing the self-interest and the business case. We look at what has happened in the last 20 years. These are the most important milestones. Carbon Tracker, Fresh Fuels, PRI, Creative Principles, Carbon Disclosure, Montreal Pledge. I'm not going to go into all of them. They're all very important, but the Carbon Tracker was probably the most important recent development. So what the Carbon Tracker did is they said, well, if we have to stay at 2 degrees, which, you know, we're not going to stay at 2 degrees, but if we have to, how much can we burn? So they said 26 gigatons. How much have we burned, or how much can we still burn? So we can still burn another 565 to stay at 2 degrees. But how much is left in the ground? 2,800 gigatons. Oh, so that means 2,200 gigatons we can't take out of the ground to stay under 2 degrees. That means the energy companies, which are claiming the fossil fuels, whether coal, gas, or oil, are calculating that as a certain price that they are being able to extract it. If you can't extract it, it doesn't have a value. So I'm not saying that they won't extract it, but this woke up a lot of investors said, wow, I have massive exposure and the value of those assets are much less than what I thought they were. Here's a breakdown of that, and I'm happy to, you'll have the presentation already. If you look at the money flows, particularly of the massive drop in value of coal companies, most of them going out of business because the market is not there. A $1.3 trillion wipeout in the oil sector where oil was at one time, people were paying to take away the oil because there was just so much. Here is some information on the breakdown in the money flows in the ESG liquid space in the last couple of years. Europe, United States leading the way, Japan growing, and Australia and New Zealand, and Asia will probably grow faster than Europe. Then if we look at the green bond market, it's going close to 400 billion now. It's really, really booming. And if we look at the amount of money pouring into R&D, life science, energy efficiency, construction, and renewable energy over the last 10 years, so in 2009, 2019, it's close to $11.4 trillion, but it's not on the cover of the New York Times or the Wall Street Journal. So that's significant money flows. The areas that a lot of the impact investors are looking at: energy, food, water, transportation, education, and healthcare. However, if we look at the results, it's been pretty pathetic. If 30 to $40 trillion is going into ESG and impact, how could we have so many problems? Climate change destruction, biodiversity loss, water shortage, food shortage, health crisis, income inequality, pollution, threats of war. So either that money is not going in that direction and people are, as they say in the United, juking the stats, which mean they're falsifying the figures or exaggerating them, or we have to double down and put even more money, or the present ESG and impact is just a death march in the wrong direction. We're going slower in the wrong direction, and we need to take a more restorative approach, which is what I believe. And I don't believe this incremental moderate improvement is the right strategy, because it's not working. It's not working. It's just everybody, you have to look at ESG and the PRI. It's a fitness club. Everybody wants to have a member. I don't get on the exercise machine to do the work. So we're part of the club, but we're not actually changing anything. If you look at actually the ones that are actually doing the most, they are talking the least. And the ones doing the least, they're talking the most. So people start believing the press releases out of Silicon Valley or Wall Street or London or Tokyo, and it's not true. It's not true. So why is so much activity? Mainly carbon has a cost now. And on top of that, we have close to 3.5 times the global GDP and wealth already. Then we have $41 trillion, which is going to the millennials. This is just the United States in the next 20 or 30 years. And they are particularly keen on this whole issue of restorative. And most important for the financial sector, they're starting to see they're going to have a problem keeping the talent because they have not been moving fast enough. The financial sector, since the crisis, have only been spending money on ICT, cybersecurity, compliance, capital buffers, and bonuses. They have spent nothing, zero, on capacity building internally or externally. And they are now starting to feel the pinch because a lot of talent is leaving because they've had it. There is massive opportunity. We probably have the greatest opportunity in the history of mankind. Zero emission real estate, public transport infrastructure, fuel-free energy, carbon sequestering red and blue carbon, investing in the two largest employers in the world, hospitality and agriculture, water, affordable healthcare, climate resilient cities, and living wage. These are all profitable industries that are restorative. So it's not a shortage of deals. We are seeing a paradigm shift in investments. Here are some simple, non-sexy ideas. Public transport infrastructure has to raise $2.3 trillion every year. It's low carbon, steady cash flow, no volatility, no technology risk, and AA rated often. Community banks in the US is $2.5 trillion industry. It's 98% of all the banks in the US are community banks. Secondary market DFIs, fuel-free energy, and second generation engagement. Public transport ticks really all of the boxes. It's one of the easiest ways to decarbonize portfolios and help society. So the financial firm the herd is forming, and you can create a sustainable portfolio if you want to. This is not a suggestion of how you should divide it, but basically people are seeing if they want to, they can integrate sustainability in all of their assets. It's not that challenging anymore. And I like to see ESG as not a niche market. It's a big party. We just got here early. You know, you arrive at a party and sometimes you say, well, this is going to be very boring. There's nobody here. But you have first mover advantage for the food and the booze. And then people show up and you have a great time. We are here, we are early, but the herd is really starting to move and this party is going to be massive. If you look at real estate, the Empire State Building, formerly owned by Anthony Mailkin, he was not a fan of sustainability at all. He did the world's largest green retrofit, sold the building, made a lot of money. The largest SDG real estate project is in Asia. It's in Bangkok by the daughter of the CP group. Fuel-free energy is a no-brainer. People are seeing that. It's competing now with baseload electricity, other forms of fuels. Next steps is grab some of the low-hanging fruit that we've been talking about because there is no shortage of opportunities. And we see that very clearly as we speak to the financial sector and we start to show them, but they only know what they already know. And we have to move away from this obsession with ribbon cutting. We need people who actually dig the holes. We have enough people cutting ribbons and taking credit for something that is silly. We need people to do the work. And we have to move away from hunting. The financial sector are hunters. We need farmers. The financial sector are incentivized for short-term behavior, which is hunting. And we need to be restorative because it's a much wiser way to restore situations so you have something to eat next year. What you can do is, to paraphrase Yoda, do or do not, there is no try. We need to get away from these silly polar bear photos that every ESG fund seems to put in their brochure, or a windmill. This has nothing to do with the activity, and it's a meaningless photo, and you're not saving the polar bears either. Time is up. Thank you for your time.
Thank you. Thank you very much, Robert. That polar bear thing was, that was very nice. Yes, they should stop using the polar bear and start being more practical. That carbon tracker you mentioned was very, very nice. In fact, I had not thought of it in that direction. That they have an investable surplus. It is useless investments because they will never be able to use those fossil fuels.
If you know, I don't think they'll be able to take it out of the ground because I think the climate problems will just accelerate. So if you can't take 2,200 gigatons and you have them on your books for whatever, $40 a barrel or $60 a barrel, and your accountant wrote off on that, but you can't take it out, don't you have to redo your books, which means the value of your company is much less?
Absolutely, absolutely. And being a finance guy, I was the CEO of a bank, and I run an investment bank. So yes, that is alarming. That is really alarming, given the dollars that are put, that we have all put in the oil companies. That is an alarming situation. Tell me, we work with a lot of we work with a lot of financial institutes, companies, large conglomerates, and we always have a problem saying the fund managers are able to put a price on environment impact, and they are not able to put a price on the social impact.
No.
So usually what happens is then they select a cause, or they go in the direction of the environment impact and not the social impact. So do you kind of agree with this, or do you have a comment on this?
Yeah, it's true. It's people find it easier to calculate CO2 emissions or energy or water or waste or fines, because you'll probably get quicker a fine in many countries if you pollute rather than abusing staff. You know, you only see the extreme abuse on the social side when a factory in Bangladesh collapses and 1,500 people die.
Correct.
So prior to that, they weren't getting really serious fines for that. So that's one of the challenges, because people are not, are not paying for, let's say, the lack of health or good conditions enough. But if they were, then it would be a cost in their balance sheet. You would hope that companies would realize that treating their employees well is in their interest. But when you see the wealthiest man in the world who does everything to cut costs and, even urinal breaks and not willing to give proper salaries like Amazon, it's very hard for a factory in Bangladesh or in India to say, oh, we should really be compensating our employees well when they're being squeezed on price. So it's true. The social is harder to capture. I used to know actually the ones that actually had great social reports were actually quite awful places to work for. Like the Body Shop always won awards, but Arnita Roddick was not a very pleasant person to work for. She was quite awful. So it's unfortunate and it's true. But at the same time, I get a lot of large multinationals who complain that most of the investment managers hardly ever ask for their sustainability report.
Yeah, because we work with a lot of CEOs. We work with over 400 companies in India alone, and I have had CEOs admitting to us, saying I cannot quantify, put a number to the social impact, and that is why we put it on the back burner. Whereas we can always quantify the environment impact, and I can tell the stakeholders that, okay, by this and this year we will benefit of so many percentage.
There are some companies that provide insight into the social performance of the companies, and I even knew some companies who were kind of a bit spiritual, who would hire clairvoyants to put their hand on the clothing to see if it was made in pain and suffering. Unfortunately, that was not enough accurate model for the investor to make a determination.
Superb. So we move on to Raakhee, but I will have one more question for you and Richard, both on the ESG exchange.
Sure.
It is a part of the CASI strategy, and we are having a difficult time. So I will be asking you and Richard a question on a friendly advice rather on how do we take it forward. That is at the end of the show today, but right now we move on to Raakhee. Raakhee, are you there?
Okay.
Yeah, hi Paresh, am I audible?
Yeah, you're audible. Please tell us your thoughts, tell us your angle. Please let us know your angle on the ESG.
Sure. Thanks for the speakers. Richard and Robert made some excellent presentation and thoughts about ESG. So I'll perhaps give a little perspective around, how as a fund we have approached ESG. I work with a private equity fund called as GEF Capital Partners. We are spread across 3 locations, US, Brazil, and India. So in India, we have a fund called as our South Asia Growth Fund 2, where we focus around specific, our mandate is around investing into resource efficiency kind of companies. So we typically look at investments into the clean energy space, the energy efficiency space, the waste management, etc. And I think it's important to understand that when we talk about ESG, I think most of the times, and not all of them, but most of the people do confuse between the what and the how. So sometimes, most of the times, when we talk about responsible investment or sustainable investment, sometimes it kind of gets construed as the ESG, but ESG essentially is how do we run businesses? How do we ensure that the businesses function from all environmental, social governance function, despite the fact whether it's a responsible investment, a sustainable investment, or it's a normal investment. So I think apart from the fact that we look at investments into the resource efficiency sector, for us, it's very important the moment we start engaging with a company in terms of what the current ESG level of the company is. And as an investor, when we come in, what is the value proposition? What is the difference that we can bring in when we step into a company? And again, in India, you will have companies working with different kinds of ESG parameters. I think many of the multinational companies or companies that have larger manufacturing footprint, etc., perhaps might have more evolved processes. But those in the small scale industry, those in the medium scale industry, I think like some of our speakers earlier spoke about, it's basically essentially about survival. ESG perhaps might not be the priority for them. It's not that that's not their intent, but perhaps that's not their priority for them. So as an investor, when we come and invest into small, medium kind of enterprises in this particular sector, it's very important in terms of what is the difference that we bring in once we invest. And because we are a private equity, our typical investing period could be anything between 4 to 6 years. So when we look at a company, we do a very detailed environmental, social governance due diligence, and that essentially gives us an understanding of where the company stands today, both in terms of what the risks are, what the liabilities are, what are also the areas in terms of improvement and opportunity. And once we have a fair understanding about what the gaps are, then post the investment, we start working very, very closely with the company in trying to improve their environmental, in trying to improve their social, in trying to improve their governance aspects. And again, these are not to be again confused with the whole impact aspects, because for us, measuring impacts is important as a fund, but then it's important that we first put these hygiene factors in place when we work with the companies. It can involve right from fundamental things in terms of regulatory processes. I mean, does the company have all the regulatory processes in place? Does the company have the necessary skills and capabilities to take care of the footprint that the company has? Does it has the necessary environmental social management systems and the standards? What kind of air emissions and what kind of wastewater emissions, what kind of waste discharges, etc., that the company has, and how do we kind of fix all of that? Human rights, labor issues are very, very important for us, and especially the fact that we sign up for ILO standards, we sign up for UNGP standards. It's very important in terms of understanding how the worker rights are, what the labor rights are, what the wages are, what are the working conditions, and wherever required, working closely with the company to try and make changes, to make improvements. One another thing I also want to kind of bring in over here is most of the times, and at least some of the reports which I look at, in terms of ESG disclosures or a lot of the other reports that get published, there is a lot of focus that kind of gets over the governance factors. So corporate governance, the board, the integrity, the ethics, and all of that is important, but ESG is just not that. I think ESG constitutes a lot more, and I think more and more in terms of the environment factors, in terms of the occupational health and safety factors, in terms of the labor working conditions, the workers, etc. I think it's very important for us as a fund. We have been working very closely with our portfolio companies to make necessary interventions to develop systems and processes, and to see a kind of a step change. That's our expectation, of course, to see a step change in terms of what it was pre-investment versus the post-investment. And then, of course, in terms of, how do we How do we align our investments with sustainable development goals? How do we align our investments in terms of the specific metrics that we measure and evolve, be it in terms of energy, be it in terms of water, be it in terms of the materials, and also in terms of certain social indicators like, what is the kind of quality employment that the company is creating? What kind of a gender diversity are we looking at over here? I think these are aspects that we then try to, bring in and measure over a period of time once we have this fundamental systems put in place. So I think both ESG and impact goes hand in hand, but both are very clearly, I think as Robert very clearly articulated, both are very clearly different things altogether. And I think when a fund looks at an investment into a company, I think these need to be factored and looked upon accordingly. I'll sort of pause here, Paresh, but if you have any questions or if you want me to further delve into any other details, happy to.
Sure. Thank you for keeping it short. That gives me a lot of time to ask you a lot of questions. So, I of course I have questions. See, last week I had a speaker. We had Arpinder Singh, the partner at Ernst & Young for India. He's a very senior guy in this business, and he's a very close friend. So he was telling me, at the seminar, that one of the things that he always pushes, or Ernst & Young partner always pushes for within CSR and sustainability framework is how do you monitor ethics and governance at a board level? So not only putting the CSR agenda at the board's table, that is thing number one, but also to make sure that the board complies with ethics and governance along with the CSR. So is that something that impact funds look at? I'm not asking you about your fund. I'm asking you as a fund person, give me a generic answer from India point of view.
Sure. No, I think that's an important aspect that you brought about, Paresh. I think when, it all depends upon to what extent funds would want to push their envelope further to get into some of these details, in terms of trying to understand, okay, what's the ethics of the board, what's the integrity of the company, how promoters have in the past looked upon these issues. And I think a little bit of initial diligence goes a long way in giving a little bit of that insight in terms of how serious the company is on these aspects. Because as an investor, if these are important to you and they should be important to you, then you are able to, bring that perspective once you come on the board to say, okay, look, I mean, for me, integrity, ethics, these processes, policies are important. And again, it's not just about having a process or a policy in place, but how do you kind of operationalize it? But having a little bit of understanding about how the company has functioned in the past will give you a lot of insight in terms of in what direction it needs to be taken in the future.
Okay. One more question. You mentioned that you mentioned a very interesting thing that when you are entering a company, when you are investing in a company, you look at the current ESG levels.
Yeah.
And then you tend to look at where do you take them once you enter the company and how do they move forward on the ESG. So again, I will refer to one of the speakers. We had Chirag, a fund manager. He runs an impact fund in India. The quantum impact fund. So,
Sure.
but they invest only in listed companies. There is a big difference when you invest in listed entities and unlisted entities.
Sure, yeah.
So, as a fund manager, when you look at a current ESG level, how do you actually understand the current ESG level? Do you follow a particular rating, or do you outsource the consulting? Do you in-house the study of the company's ESG rating? How do you understand that?
Yeah, so essentially, first of all, we don't typically invest into public listed companies. We invest into private companies. So in that sense, we do get a lot of leverage in terms of, doing diligence the way we want in terms of, the frameworks that we have. So essentially,
but it makes your job harder, a listed company. That is exactly why I asked you this question, because Chirag works at Quantum Fund. They invest in listed companies. They find a lot of data from the stock exchanges. Whereas in your case, data, you have to make data, you have to create data. because they would not have been submitting at the stock exchange. So how do you do that?
So we essentially work really with the experts over here. We work with the advisors over here, wherein we actually undertake a detailed due diligence in terms of meeting the management, doing site visits to basically get the data and the information in terms of the various frameworks that we follow as a fund, and then having discussions with the relevant people in the management. So that gives us a lot of visibility in terms of, the actual on-ground conditions, the on-site conditions, trying to understand the overall thought process the management has around the whole ESG aspects, what they understand by environment, what they understand by social, by labor, etc. And then, in fact, for us, it becomes then very critical and important that we are able to tailor the sort of, corrective action plans, or rather, how do we work with the company in a much more structured fashion than just being very generic about it. So I think in that sense, we do have a lot of work that we do using experts and using the advisors for all our deals. Now, and again, I think Paresh, just to touch upon the fact that you mentioned about how do we the ESG investments in public listed companies. I think that's also where a lot of there is a lot of confusion in terms of what data you finally rely on, in terms of which reports do you rely on when you're making investment into a public listed company, right? I mean, you are getting so many ESG disclosure reports, you have so many sustainability reports. How do you make sure that whatever report or whatever data that is being revealed to you is the most authentic, And I think investing into a public listed company with just an available set of data that is there, I think sometimes even that job is as harder as well.
Correct. No, that is a service which we provide. That is one of the things that CASI does, helping companies understand ESG when they try to invest. So that is one of our services which we offer in a couple of countries.
Sure.
So thank you very much. Mitesh, do you have any questions, please? We are at the end of our show. We have time for like 2 questions.
No, sir, I do not have any questions. Thank you.
Robert, Richard, do you have any questions for the young fund manager or for each other?
No, I don't, but it's wonderful learning from all of you.
I don't have a question. I have a advice. If all of the 3 million people in your network want to change business, the most effective way to do that, particularly if you're studying at a ranked university or MBA school, is to interview the recruiter. So when the recruiter comes along, ask them values-driven questions which are important to you, because if you refuse to work for a company because of their behavior or because of a lack of alignment of values, you will have more behavioral change of the company rather than going to work for the company and trying to change it from within. It's basically trying to scratch at a safe with a plastic spoon. So use your leverage. When the recruiter comes to interview you, switch it around and you interview the recruiter.
Thank you very much, Robert, for that advice. It makes a lot of sense. That will definitely put pressure on the recruiters, not only for ranked universities, from anyone. If someone comes up to you and asks you a question on plastics, let's say, and 100 people come to you and ask you a question on plastic, it will create an impact in your mind on not using plastic. So the people will get psyched, So you are absolutely right. That is awesome advice for our 3 million volunteers. We could really use it. Yeah. So with that, thank you very much. Please stay online. We'll stop the recording. I have a question for the speakers. So thank you very much. This was another episode of In Conversation With. And as mentioned earlier, this was executable advice. Thank you very much.
Thank you.
Mitesh.